Yeah, well, understand that ultimately risk management is going to be more important to you. If you're going to be successful, risk management is going to be more important than necessarily the methodology you ultimately gravitate to. Second, you need to develop a methodology that does have an edge, meaning it doesn't have to be a big edge, but it means over time you're making more money than you're losing, and it's a repeatable process, it's well-defined, and it doesn't generate huge drawdowns to get your upside. So you have to develop a methodology with an edge, and that takes time, and not everybody's going to be able to do it.
Welcome back, everybody, to the SteadyTrade podcast. It's Stephen Johnson and I and our amazing guest, Jack Schwager, today. Jack and I go back, gosh, it's been probably 7 years, right? 7, 8 years?
Since you wrote your book,
Yeah. We met in New York City, where I had the good fortune to interview Jack, with him doing all the interviews. It was nice to put him on the other side of that conversation. Jack, of course, is a recognized industry expert in futures and hedge funds. He's the author of a number of widely acclaimed financial books, and perhaps best known for his best-selling series of interviews with the greatest traders and hedge fund managers of the last 3 decades. Market Wizards, which came out in 1989, undoubtedly changed my life. I'll never forget reading it. I can't tell you, even when I read it outside, I was in Spring Lake, New Jersey, at a table. It was like near an ice cream kind of restaurant, little ice cream parlor. And all the men who passed me saw me reading Market Wizards, and they were like, "Oh, you are going to love this book." And I was like, really? These are complete strangers. So excited about that book. And now I understand, of course, why. And it also influenced me in a lot of ways about how I was going to write my book. So I can't thank you enough for that, Jack. But all those books, the whole series, and today's book that we're going to be talking about is part of that series. And he has a lot of books, but the other book I want to do a special shout out for is one that I really liked called Market Sense and Nonsense. That came out in 2012. And it's really just a collection of investment misconceptions. And I think, especially for our audience, that is a book that'll be really great. Jack is also the co-founder and chief research officer of Fund Seeder, a firm that seeks to find undiscovered talent, trading talent, worldwide. And fundseeder.com is where you can find that. And today we're going to be talking about a book which is called Unknown Market Wizards, a fantastic read. I've been devouring it since it came in. It came in about a week ago for me. So we're going to be talking to Jack today about those unknown market wizards. Thank you, Jack, for being here.
Oh yeah, thanks for the invitation.
I think I first want to just speak to how it is that you find these market wizards. And yes, for this particular book, especially because they're unknown, how is it that you hear about them in the first place?
Well, multiple ways. About 4 of them came actually from FundSeeder, the people who had linked their accounts to FundSeeder. And the concept of FundSeeder, I'm assuming a large part of the audience won't know, was to really find undiscovered trading talent by providing a platform, an analytical platform for traders. So that was one major source. I happen to know some of the traders before, like Peter Brandt, who was actually kind of not really unknown. He's unknown in maybe he's not managing money, so he's not necessarily known in the investment community, but he is known among traders because he's developed a large following, on Twitter in the last few years. But he's the one exception, and I want to have him in the book anyway. But I knew Peter, for a while. A couple of other traders in the book contacted me, and I sort of kept, like Jeff Newman wrote me an email describing what he had achieved before I ever started this book, I just saved his email. I told him I wasn't doing a book, but if I did, I would get back to him, and if he could prove his claims, which were pretty out there, like, which he did. It was essentially that he turned $2,500 into 50 million. And of course, I got the statements, but so yeah, he had contacted me initially. A couple of other traders had contacted me for other reasons. Jason Shapiro, my book was an influence, got him into the industry, and he was coming to Boulder for a wedding, and he asked if I would be willing to meet with him. And when he told me he didn't want to be in the book though, but when he told me his story is pretty fascinating. So I finally, when I was doing the book, I called him back, or emailed it, I should say, and sort of said, look, I think it'd be great to be in there. And it was back and forth. He said no, and then finally he said yes. But so again, Chris Camillo, another trader in the book, had contacted me for a totally unrelated reason. And I said, want to speak to me for advice about a project. And I said, well, if you want to fly into Boulder to have lunch, I'll meet you. So I met him that way. And then, so you have the people I knew beforehand for various reasons, the people from FundSeeder. And the last category is I put out some tweets saying, I'm doing a book looking for unknown, solo traders with long-term, preferably over a decade track records and phenomenal return risk or exceptional compound return. If you fit the description, or if you know somebody who does, let me know. And that filled out the remainder. So
yeah, and just for our listeners, just so you guys have a sense of what's in store in this book, in addition to the trader who turned his account of 2,500 into 50 million, there's a trader who achieved an average annual return of 337% over a 13-year period, a trader who made tens of millions using a unique approach that employed neither fundamental nor technical analysis, a former ad exec who used classical chart analysis to achieve a 58% average annual return over a 27-year span, and a promising junior tennis player in the UK who abandoned his quest for that career and trading and generating a nine-year track record with the average annual return of just under 300%. I mean, these are really quite impressive, Jack.
Yeah, they're pretty amazing. I really didn't expect to find track records like that. I thought, the ability to make those type of returns was maybe existed when I did the first market versus book, when you had real inflationary times and trends that were very, very powerful in one direction, and you didn't have the computerization yet in the industry. So people who were early on to trends could have made exceptional gains. So I thought it was no longer possible to do that, but apparently it is.
Yeah, Stephen, can you believe those numbers?
It's exceptional, and the other thing that's exceptional, Jack, is the amount of brilliant traders you've spoke to, like from market wizards to unknown market wizards to new market wizards. There's a lot of wizards there.
Yeah.
And if just to tell you a bit about the podcast is geared and designed towards aspiring traders, people who are just in ordinary jobs but they want to get out. And you've spoke to the best of the best traders. So I was just curious, what characteristics truly define a good solid trader? Because I saw you in an interview, you said a lot of people fail really badly quite a few times, but those people went on to be the best traders. So is there a characteristics you've come across in these hundreds of interviews you've done?
So the specific question you're asking then is what?
The question that I'm asking is, what defines a brilliant trader, or what characteristics do you need?
Yeah, it's, first of all, methodology, they're all over the place, and they're all different. And, methodology doesn't define it. Personality doesn't define it. These traders have certain commonalities, which other people could have some of them and not be, certainly not do anything like what these traders have done. But there are certain essentials. So they've all developed some precise methodology that has an edge, whatever it may be. And So it could be having a particular skill in picking chart points to put trades on. It could be on being exceptionally skilled at trading fundamental events in the market. One trader is in the book is a contrarian. So it's a matter of marrying that, going in against what has been a major trend, but with the type of market knowledge and insight and risk management that you can do that and not get carried out, and be successful. So everybody develops their own particular methodology. So what they do have, like I said, is the developing a specific edge, risk management. Almost all the traders have a very strong emphasis on risk management. They tend to be flexible, the ability to change on a dime if they're wrong, to get out very quickly if they're wrong. Patience to wait for the right types of trades and bypass those periods where there aren't opportunities, not get distracted by wanting to do something when a trade dictated by their methodology doesn't exist. So there are all sorts of things like that. There are more character and psychological traits, and of course the methodology is specific, but it's a different type of fortitude and ability to not be influenced by the types of emotions that drive people to make mistakes in the market.
Yeah, no, you have a quote that will stay with me forever in Stock Market Wizards. It's being wrong is acceptable, but staying wrong is totally unacceptable.
That's a good one. I really liked Richard Barg's interview, The Importance of Mindset.
Yeah.
His journey sounds like it was bumpy in the beginning for him. And yet that perseverance, that's what really stood out for me. He was so perseverant.
Yeah, well, he knew he wanted to do this. And it's not that he did badly, it's that he worked for a prop firm, had a line of approximately, when he started out at least, had a line of about 30,000 British pounds, which is not much. And they were drawing money out every month for office, space.
Yeah.
So he could make, they were drawing out like almost 10%. So, he could make 70% in the year and still be break even or behind the eight ball. So it wasn't that he was doing bad. It's just that he was just keeping up with his expenses, essentially.
Yeah. I was struck by his seeing, of course, I'm always looking through the lens of the mindset, right? How that impacts a trader. And he talked about how he really had to reconcile with his sense of always comparing himself to other traders at his firm, where he would compare himself to them or beat himself up if he didn't have their results. Talk a little bit about that.
Yeah, so he was young. There was one exception that, before this book, where the traders knew each other, and that was Michael Marcus, who then introduced me to Ed Sakota, who he considered the best trader he knew. And so Ed Sakota was kind of his mentor. They had been together at some point. And then Michael Marcus hired Bruce Kovner, who went on to be Caxton and so forth. There were three traders there. There's a connection. So in this book, the only other time that happened, there were three traders connected because they all got started in the same prop firm. Mm. So one was there from, before the other two. So and Richard was the youngest of the three. So he came in like 5 years after Amrit started. And it's not so much, they didn't even work right near each other, but Amrit sort of gave him some advice, and so did the other trader, Daljit, who was also a senior. So, but he was comparing himself. Amrit is a trader you mentioned that was making 337% a year. And back then it was even higher because of smaller capital, but he had one crazy year where he made over 3,000%. So, he's comparing himself to, traders that are just extraordinary, which is not a fair comparison. He always did okay. If he if he was just trading his own account, but he had the support of the prop firm. So
Yeah.
I guess if he was just on his own, he wouldn't have learned. He wouldn't have picked up stuff from the other traders.
Yeah.
He wouldn't, you know. So
when you're comparing yourself though to greatness,
Yeah.
in a lot of ways that probably drove him a lot harder because he was not comparing himself to just average type
Yeah.
traders. It just called him forth more once he got out of his own way of having kind of hinder him.
Yeah, and also, he had to mature. I believe it's in his interview where he talks about how he would miss a trade and other people got it. And it just killed him that other people having, this was a monster opportunity. He missed it. And these other people were really profiting, but he matured. And over time, was able to say, well, yeah, I missed it, but good for the other guy. He had to get past that. And that's part of the mental maturity that makes him a really good trader. That's part of the mindset thing. It's not,
Yeah,
you have to let things like that get to you, and on the contrary. So
it's just going to cost you.
You have to get that mental maturity.
Yeah, that I think it's Brandt who has the title of his chapter is Strong Opinions Weakly Held.
Yeah.
What a powerful quote. Isn't that amazing, Stephen? Strong opinions weakly held. Oh, that is an amazing quote.
Yeah, and that's his philosophy basically. So he puts on trades. He's strong for the trade, but as he paraphrasing Peter, the minute the market puts his hand in my pocket, I'm really quick to get out. So as long as it works, fine. But if it doesn't work pretty quickly, he's out. Yeah. And it also relates to this thing about Twitter, where he has a large amount of followers now. I think he has like somewhere close to 400,000, I think. Wow. But in any case, he would get people comment on, and people always, not all people, but a lot of people feel they have to put other people down so they can feel okay. So he said, so Peter put out something like, I don't know, buy the S&P, I'm not buy. He doesn't give recommendations. He would say he might refer to a trade he did, or here's a trade I'm doing, or whatever it is. And let's say he's buying the S&P, and he would get like people tweeting, "Oh, yeah, Peter was like recommending the short side of the S&P 1,000 points lower, right?" Sort of saying, how could you pay any attention to him? 1,000 points lower, he's telling to sell it, and now he's saying to buy it, and totally missing the point that he was out of that trade like probably a day later, and his opinion, then he had no opinion. Then he'd have to wait for another spot to form an opinion. And he doesn't try to pick, he's not predicting. He never predicts where the market's going to go. He's just trying to pick a point where he thinks he has a good return risk opportunity at that particular point in time in that particular market. He's not predicting that it's, going anywhere. So, so people just, so that quote, strong opinions weakly held, relates very well to that type of attitude among some people.
Yeah. Not having the ego drive all of your decisions. You're really able to keep it tamed.
Well, more that it's not a matter, not a matter of staying with positions because you said something. It's a matter of picking your spot. If it doesn't work, you're out, and that's that. Then go on to the next thing. Yeah. So that's different than saying I think the S&P is going up, for the next 5 years or whatever.
Yeah.
This is something again I saw with you in an interview, Jack. You were saying pick the place where you're going to stop out before you get into the trade, because as soon as you get into the trade, your opinion is objective.
Right.
And it's just it's the same mistake all traders, like any trader who doesn't really make money, it's the same mistake. They always think about what they're going to win. They never think about what they're going to lose, right?
Yeah. There's a couple of things in which you just said. So, ordinary traders will think about how much they can make. Really good traders are always worried about what they can lose. And this idea about getting in or deciding where you get out before you get in, most easily done with good till cancel stop. But some people can have very strong discipline and can trust themselves to act on it. But that concept is something that's come up repeatedly in every Market Wizard book. and was probably first cited by Bruce Governor, and he just said exactly that. Know when you're going to get out before you get in. That's critical because it places a limit, barring exceptional circumstances where there's a huge market gap because of some unexpected thing. But under normal circumstances, it defines how much you could lose on a trade. And the decision comes before you're in the trade, so you have the advantage of objectivity.
I was looking at one of your books, Market Sense and Nonsense, and I found something really interesting because you were saying, that it's legal jargon to say past performance is not indicative of future returns. I was really interested that you said, because this is how I learned the stock market, by history doesn't repeat, but it rhymes. And we trade what happens in the past because it happens again. But when you were talking about investing, what struck me is the opposite of what I've learned in the past. You're saying the past best performing stocks perform worse than the average ones.
Yeah. I mean, and I did several studies. I did it with the entire market, the entire S&P, or what was equivalent to the S&P before the S&P. I think I had data back to about 1850 or something like that. So looked at when you invest, if you're investing after the worst past 5, 10, and 20-year periods versus investing under, the best, corresponding periods. And I did it for hedge fund strategies. We're using hedge fund research list of 35 or 7 or whatever it is strategies, and looking what happens when you invest in the best recent strategies versus the worst. But it can, so I did it in several different ways. And in each of those experiments, it basically came out that investing in the best recent strategies, or or market or whatever, tended to do much worse than the reverse. And that's not, it's understandable. I mean, it's counterintuitive because people do the exact opposite thing. They look at what has been, which has been the best performing type of strategy or hedge fund, and that's what they invested. But there are mechanics that are set up because of that really flip the odds. So, for example, if you use hedge fund strategies, if a particular hedge fund strategy is done very well, and an easy example is if you take a sector strategy, or it's true for stocks too. If you look at, and I think that was the other thing. I think the third experiment I did was I used the 10 S&P sectors. Again, looking at if you invested in the best sector of the last 1, 3, 5 years versus the worst and the average. So in all of those cases, the best did worse than the average and usually did worse than the worst. Because, so let's say you pick a sector, let's say the best performing sector you pick over the past 10 years has been energy, okay, as an example. So, what does that mean? Well, that means if that's true, then you can kind of take for granted that you've had a big bull market in crude oil. What does that mean? Well, if crude oil prices have gone up a lot in the last 3 years, let's say, that means that you now have, marginal wells being brought into production. You have more investment in energy expansion. You have substitute energy sources, becoming more competitive, and and people conserving more, right? So you have all of these supply-demand forces, which are triggered by that very fact that this was the best performing sector, which all are now going to act against it. So, and there's a bit of a reversion to the mean there too. If you have a manager that fluctuates in performance, but you invest, and you see this in CTAs, particularly in CTAs, in Market Sense and Nonsense. I think I have lots of examples where if you can see investors coming into a CTA as he has exceptional performance, and then liquidating, at the lows. They almost go together perfectly. So, so if a CTA is making money, but is cycling around some sort of uptrend in return, if you're buying him or investing when that CTA is having his upside excursion, the odds are not good, because just a normal fluctuation around his uptrending mean is going to give you a bad entry point.
But if you look at the likes of the EV sector and Tesla and NIO and stuff like that, would you not just say it for the next 10 years, that's the golden sector, it's done? Or would you put forward the argument that you've just put forward with energy and say, nah, it's going to get too competitive?
It's just more of the general concept of getting out of the idea of looking what performed best in the recent past. It's not a good guideline. Now, long-term track records, have some meaning, but that's not necessarily because of the recent past, it's because of the entire track record. But focusing on the recent past is not a good idea.
Mm-hmm. Jack, one of the questions that I had was, after this is like 30 years of you talking to some of the best traders in the world, what has been impact on your trading over these years? Like these stories, these conversations, all that you've learned from them. I imagine because they're so diverse and they're so, eclectic, how does one listen to all these geniuses and then kind of pull out for yourself how to proceed or who you might listen to or feel inspired by?
Yeah, so for myself, as with anybody else who could read these books, it's a matter of picking out what resonates for you. And it's different for everybody, So when somebody tells me, which chapter I like best, I have no idea, because it's always a different chapter.
Yeah.
Because different people will bring, will, like I say, resonate with trades. And so for myself, I think the risk management, which I had some inkling of before the books, but certainly that reinforced it. The idea, decide where you get out before you get in, is something I do. And I'm not a particularly good trader. I'm certainly no market wizard for sure. And but insofar as I'm net profitable, a lot of that is because I've absorbed that lesson of always when I put on a trade, unless I shouldn't qualify. There is an exception. There's a difference between trading and investing, right? Mm-hmm. So if I'm putting on a trade as more of an investment, like I can think back in late 2008, I thought we were seeing a classic panic sell-off, and so I put on some long-term calls and stuff like metals index and the Chinese index, and just because I thought they're down 75%, they'll in the next year or two, I don't see myself losing much on this, and there is a potential. So I had no stops on that. That was just like, that was a bet. That was a kind of investment bet. So, but with that exception, any trade I do will always have a stop. So that's at the time of entry, and that's something that comes my being influenced from the books. And there's other things you pick up. I don't want to go too many, but here's another example from one of the traders. Scott Ramsey, who's a CTA, I picked up the idea about correlation in markets. And it's a really sophisticated idea. And it's also, everybody knows risk management and discipline. This is the kind of idea that you don't have, So these ideas pop up in the various books. And this is an example of something that no one else had mentioned. And that is correlation between markets, the usefulness of it. And it's not the correlation that's useful. It's when you have a correlation and it breaks. So I can think of a very specific trade. Earlier this year, we had a situation where gold was coming up for a second high, and I'm trying to think. I think it was the S&P. At the time there was correlation, I believe, there was a strong correlation between gold and the S&P, which is kind of odd because a lot of times in history you get the inverse. But at that particular point in time, they were very, very strongly correlated. And what happened is you made the high in gold, you had a big down, and then you rallied again, and S&P was rallying. And you have a point in time where between that first high and when gold came up to the same point, the S&P just had gone tremendously up. And so gold had lagged, and in fact, you had the S&P making new highs, and gold went down a day or something like that. So I remember going short or buying puts. I forget which it was. I think it was buying puts, just on noticing that break of correlation. Now, I would never have noticed that trade, or certainly not done that trade, had I not had that other interview. And so, there's some interesting, it's also the idea of, I'll throw out one more because it is interesting.
Yeah.
Marty Schwartz, and this is like, again, another kind of one of these things a trader says that you don't hear all the time. And he said, at one point in the interview, he said, if you're ever in a trade that you're really worried about and the market lets you off the hook easily, don't get out. And so, the idea like, the market closes at new highs on a Friday and it looks like it's going to run away and you're short and you're thinking how much you're going to lose when the market opens up. And then the market opens up in the lower Monday, that type of, or Sunday night, that type of situation. And so this was a particular case where I was looking for pure chart reasons, I was looking for the market to a zone where I was looking for it to fail. And what I was looking at is irrelevant, but that was the idea. So I was scaling into a short and I was almost completely, 100% in the short. And then there was a Friday, an unemployment report comes out, and I forget what the specific, but with one of these reports, it was just completely one-sided, and there was not a negative thing about it. And I'm short, and or actually, the report. Let me put it this way: I forget exactly the specifics, but that report, so it was not positive; it was negative for the stock market. So everything about it was negative. And sure enough, I'm sure the market sells off. So I said, my first thought is, wow, great. I just identified the exact high area and the trade's working great. And then the market starts rallying. It's a Friday. It starts rallying and rallying and rallying. And I think it recovers the entire, loss on what was which should have been a really negative report. And then it closes near the high of the day. And and I'm thinking to myself, boy, I remember my son coming over on the weekend. I'm telling him, boy, I'm just going to get really killed. And that Sunday night, the stock market opened up in the lower. And I swear to God, I thought I interviewed with Schwartz. And I knew I shouldn't, I held it. And then, after it went down a bit, I got out of it a little bit. I just didn't want to tempt the fates too much, but that was it. The market, went back down again. And if it wasn't for that Schwartz interview, I certainly would have gotten out with relief that Sunday night.
Wow. Amazing. Amazing that you thought of it in the moment. But I imagine there's so many jewels buried in your unconscious from all these interviews.
I actually, that wasn't unconscious. I thought of Schwartz's,
interview.
And it was not only Schwartz, but in the Bill Lipschitz interview, there's kind of a fascinating story where he is in exactly that situation that Schwartz was describing. And I also had that story in mind. So so my own books do influence my own trading. And, but what I draw from it will not necessarily be what other people draw from it.
Mm-hmm. Mm-hmm. Well, I'm looking forward to you finding the women market wizards, Jack.
So it's hard, I get criticized for it, but I put out when I put out a tweet asking for women traders, I got many, many hundreds. There wasn't a single woman in the responses.
Yeah.
But I'm looking for 10-year plus records.
Yes.
I'm looking for really exceptional performance. So women have entered this industry kind of with a great lag. And so, I did it 10 years from now, it would be maybe a lot easier.
Yeah.
But at this point, not to say that there aren't women that are great out there, but the ratio is very lopsided.
Yes.
And so I'm trying to find people. I'm just not getting, I would have been more than happy to include women,
I totally know that about you. And I too, when I was looking for, finance people who came from a place of integrity, I actually interviewed some women. And then in the end, they said they didn't want to be featured. So I have experienced some women seem to want to stay under the radar because of a collection of reasons. But I do believe that they haven't responded to you. Maybe some of them just don't want to be known and they want to just keep their nice little, I noticed, of course, that one gentleman who was back and forth, do I want to be in his book?
Right.
And then, thank God he said yes, because he has such a great story. And because your book so influenced him to become a trader that just, but I could appreciate somebody maybe wanting to keep a low profile. And your books are definitely going to put them in the spotlight for sure.
Probably.
For sure. There was a quote at the start of your book. You have 3 really powerful quotes at the start of the book. There's no such thing as being right or beating the market. If you make money, it is because you understood the same thing as the market did. If you lose money, it is simply because you got it wrong. There is no other way of looking at it. And that is from Muswar Ijaz. Did I pronounce his name right?
I'm not sure how you pronounce his name, but I think I read that quote in some article or, whatever. I forget where I got it, but I saw that quote and I saved it because I thought it was a really good quote.
Yeah, it's powerful. It said, I think that heart of the matter is like, are you able to build up tolerance for getting it wrong? Like, if you can be with getting it wrong, that to me seems like the key.
You have to, like Jeff Newman, we talked about earlier, the guy who turned his thousands into 50 million. He's, paraphrasing the quote here, but he says, when I get out of a trade, I'm out. 5 minutes later, I don't even remember what trade it was. It's such, he's in it, but once he's out, forget it, on to the next thing. It's like, and that's the attitude that one has to have. And in virtually all these traders, that if it's not going the way they expect, they're out right away. So they're not trying to sit there and rationalize, well, this market is so stupid. I'm the only one who's getting smart enough. The market will eventually realize what I know. It's a type of thing, and this comes up in the book too, in the Shapiro chapter, The Contrarian, where, he was a contrarian all along because that's his personality. Yeah. But, he kept on blowing his accounts up until he understood the risk management side. And so, but he talks about in 97 when Greenspan came out with his famous irrational exuberance. And you know what? Well, and Shapiro says, he was sitting there and he says, gee, Greenspan and I are the only ones who understand this, right? And by the market goes down on Greenspan's comment, and that same day it rallies back again. And he knew he's screwed, but he just, you can be, and he and Greenspan were right. The market was overpriced back, then, but it went up for another 2-3 years. So being right is not going to get you anywhere. If you're not right at the right time, you'll be carried out.
Yeah, for sure. What would you say to these young beginner traders that are our viewers? Where do you point them by way of what would say the top 3 jewels of wisdom you'd give to those that are just beginning their journey?
Yeah, well, understand that ultimately risk management is going to be more important to if you're going to be successful. Risk management is going to be more important than necessarily the methodology you ultimately gravitate to. Second, you need to develop a methodology that does have an edge, meaning it doesn't have to be a big edge, but it means over time you're making more money than you're losing, and it's a repeatable process, it's well-defined, and it doesn't generate huge drawdowns to get your upside. So you have to develop a methodology of an edge, and it takes time, and not everybody's going to be able to do it. But unless you have both the edge and the risk management, you cannot. You have to have both. You're missing either one of those, you can't be successful. And I guess the third thing I would say would be to start small, because most people do not do well in the beginning, and you might as well learn your market lessons, cheaper. And the more money you throw in at the beginning, the more expensive those market lessons will be. So start small and only build up as you gain, as your equity showing you that you're doing something right.
Yeah.
Let's jump in. I mean, what I think is interesting as well, I'm sure I read this as well, it's that you don't really need to be too intelligent to get trading. you just have to have a love of the game. Would you say, and I've also read that if you're too intelligent, it can be a problem because you overthink things too much and it's quite simple. But would you say that kind of anyone can get trading if they love it enough, or is it just for some people and not others?
Well, intelligence, or more correctly, maybe not so much intelligence as kind of book learning intelligence, that type of thing. So that can vary all over the place. So I've got people who never had education beyond high school, like one of the traders in this book, to people who, who have like Thorpe, who had a PhD in mathematics and was working on a thesis on PhD physics, but he never finished it. But so you
wasn't there Bellhop, Jack? Wasn't there Bellhop?
Well, in this book, yeah. So the guy with only a high school education was a bellhop, yeah. And so education it's a different type of, you have to have a certain type of intellect. It doesn't necessarily mean a school intellect, though, so some people are just have that thing that they can just latch into the market and figure something out, or have the proper instincts or whatever. So it's not so much the education. Like I say, that ranges all over the place.
But it is interesting though that it's hard to explain, but some people just have that thing.
Yeah.
And you can't really explain what it is.
No, it's like, I'll give you a perfect example. Michael Marcus. He had, I guess he went to graduate school in psychology, I believe, but he didn't have any particular market training or mathematical skills. And I remember, I met him when I was getting my first job. He was vacating it. And we stayed, and while he was still in New York at the time, which I was, we would get together for lunch every few weeks or whatever. And I just remember that he had this talent where I would do all the analysis and come to some conclusion which might be wrong. But he would pick out the one thing that was important. There might be 100 factors in the market, but he would just have the instinct to know which factor was a driving factor. And it's instinctive. And when he interviewed for a trading position at Commodities Corp, which at the time was filled with PhDs, they kind of thought, when they asked about his background, and it was just, he had some psychology, and then the line that he just trades, when they were discussing it among themselves, which later found out, and they thought it was very funny, that he just trades, but that was the most important thing. He just trades, but he had this amazing skill at trading.
Yeah. No, because it's not an ability to look at lots of different pieces of information and put them together to make a prediction, because you've just said it, it's not that. It's the ability to just know what information is the right information instinctively, just to have the common sense to know.
Yeah. It's amazing. I can't help but think of that prop firm where those 3 or 4 gentlemen who are three that are in the book, like, boy, they have a good track record of picking the guys.
I don't know if they're still around. I think that the people who founded it I think they may have retired or whatever. So
amazing that they saw these qualities in untried traders.
They found at least these three traders that I know about. So they were apparently very good. And oddly enough, the founders came off the floor, so they didn't trade. In fact, you mentioned Richard Barge. Sort of, they tried to tell him, try to make a little money every day,
Yes.
And that was so counter to the way and that was the other thing, you have to trade your personality. So if he had tried to trade the way they were telling him, he would have not done well, because his approach was completely different. His approach was just to look for that real opportunity and then trade it heavily, not to try to make a little money every day.
Yeah. Wasn't that 2 or 3 years he tried to trade the methodology they recommended to him?
He tried technical analysis because they had other people trading fundamentals, and they really wanted somebody to trade technical, and he kept on trying it, and it wasn't really. Yeah, what had happened was he was kind of breaking even or losing money. But so I said, how did you get your track record?
Yeah.
So it was just those few times a year that he would do these fundamental trades that gave him all his profit. So, the other stuff was just getting in his way. And when he finally just abandoned it, he got better.
Yeah. Yeah.
It's because you can't, for me, it's very difficult to learn how to trade and copy and replicate someone else's strategy, right? But it's just what you said, everyone trades their own personality. So the best way to learn trading, I guess, would you say it's to just learn from as many different people as you can, pick different pieces from different people and mold that way? Or
Yeah, you can have mentors to learn certain things from, but you still have to develop your own methodology.
what would you say was the best piece of advice that you were given from all of the interviews that you've done that improved your trading?
In this book,
And across all.
well, if I said if anything, we had that question a while ago. I gave you, a general thing about the money management and deciding where to get out before you get in. That's maybe the single most important thing I've got out of my own books. But like, the examples I mentioned, the correlation, the how the market reacts after what seems to be a scary situation, those type of things. So there are other things that I've gotten, and but those are 3 examples.
The other thing I noticed across the board was the advocacy of giving yourself 3, like one gentleman, I think it's Brandt actually, who says 3 years to even get a clue of how they should trade and 5 years to reach some level of consistency. If you don't have the 3 to 5 years to achieve that competency, trading competency, you probably shouldn't trade.
Yeah, that was Peter. And, I think generally that's true. People underestimate how long it would take to develop as a trader. And it is measured in years. And sometimes it could be a lot longer. And sometimes it could be decades before you develop the methodology that really works and you stay with. So it's not as short as people would like it to be.
Yeah. Yeah. And these market wizards, these guys are incredible. And yet it took them years to become incredible.
Yeah. Well, some of them was, in this book particularly, probably more so than any other book, were successful from early on. But there's still, the other group where they blew out a couple of times before they were successful. So you really get both. I think it's more common for people to not do well or be mediocre at best in the beginning and not really become good until after a while. But you do have your occasional people who are just, successful right from the start. And, so you do have both situations.
Yeah. Yeah. This is great, Jack. It's Unknown Market Wizards. It's the 5th in the series, the Market Wizards.
Yeah, the 5th.
Can't recommend these books enough, especially to beginner traders. It really will help you see just so much the emotional volatility that a trader goes through and the technical aspects that you have to it's like going through the mud under the barbed wire. And I think just hearing those stories and the variety of stories are really, they're going to at least help you understand, especially as you begin this journey, what you can prepare yourself for, how to gird your loins for all that is ahead. Anything you want to add, Stephen? Oh, go ahead.
I'm saying, there are 2 ways you can learn, you get better at anything. You can find people who are really expert at it and try to replicate the things that they do. I don't mean methodology wise, but I mean traits that they follow. And that's one way. Or you can find people who are terrible and do the opposite. But so the idea of interviewing people who have been successful for long periods of time, and not just successful, but extraordinarily successful, you're bound to get useful. If you're open-minded, you're just bound to get useful stuff out of it. And what's interesting is that's true for novices as well as professionals. So, I mean, I can't tell you how many times people have told me that, they went through it when they were beginners and they highlight a whole bunch of things or whatever. And then they pick up the book 10 years later and they notice a whole bunch of things they didn't notice the first time because they, it's like that wonderful parable that Ed Secoda wrote as a forward and I think it was New Market Wizards or maybe it's one of the Market Wizards books. I don't remember which one, but it's basically about someone wanting to be a Jade Master. And he goes back and the Jade Master has him, sweeping out the room and doing all sorts of stuff unrelated to Jade. And after a while, he says, the piece I hold in my hand is not Jade. It's sort of like, it's the same type of thing that people, you have to get to a certain level before you start seeing things you didn't see before.
Yeah, beautiful. That's really powerful. So true. So true. Stephen, any last questions?
No, just thank you, Jack, because the first trading book I probably ever read was yours. It was a lot of audible podcasts walking to and from work before I moved into trading. So thank you for that. And I just want to just kind of just reaffirm the importance of risk management, because it's something that you've touched on quite a few times. And for a lot of the traders and the new guys who are learning, risk is so important. It's a mistake that I make a lot, thinking about what you can make, not thinking about what you can lose. Then all of a sudden you're down more than you thought you should lose. So just thank you for stressing the importance of risk. And these elite wizards, risk is one of the main factors that they have. So thank you for that.
Sure. The best trade. Go ahead, Jack.
No,
The best traders you've never heard of, Unknown Market Wizards by Jack Schwager, out now. Get yourselves a copy, learn from the masters. And Jack, please let us know when you have another book so we can have you come back. And we're gonna have to find those women. I want to see those women. And hopefully in the next few years, I just finished this morning an interview with 4 women traders who Stephen connected me with, and it was an amazing conversation. And I'll tell you, those women, I think in a couple of years, we're going to see some magic from them. So I think it's definitely
could be a source if I do it.
Yeah, for sure, absolutely. All right, well, thank you everybody for coming to the Steady Trade podcast. Stephen Johnson and I thank you. We thank Jack Schwager for coming on, and we'll see you on the next episode of Hui Ho and Aloha for now.